This week I'm going to show you the UK stocks I bought, the top riser and faller in my portfolio, as well as the share tip of the week, which is a higher risk value stock listed in the main markets. And if you find the video useful or enjoy the series, please drop me one of these to support the channel. Thank you. According to Google Finance, the FTSE 100 is up by a staggering 6.31%, the FTSE 250 is up by 2.80%, and the S&P 500 is up by 1.59%. My portfolio has actually broken the streak of outperforming the markets, losing to the large cap stocks in the FTSE 100, as I only generated a return on my portfolio of 5.13%. However, what is promising about this is that we've now overtaken the FTSE 250, and I'm only a few percentage points, about 5% behind the S&P 500, and so we could be beating the US markets with a UK only portfolio, and I think that's quite a brag, or a humble brag in my opinion, although I don't want to build an ego, so I'm probably going to try and resist doing it. Although then again, my graph that tracks this data, and I've still not received the CSV file from my broker, which is Freetrade, so that's likely inaccurate in some way, shape or form. As I've said before, a majority of my money was put into the markets after June, at which my starting point was April 7th. So on a growth only return chart, the FTSE 250 in that time period would have generated returns of around 33%. But if I'd have invested my money into that fund, I probably would have gotten a lot less. Furthermore, the next week should be very volatile for my stocks. It's either going to be a good thing or a bad thing. We have the trading update for both Games Workshop and Boohoo. If Boohoo is anything like the past period that I've held the stock, then it might be likely that the stock rises in anticipation of the results, but they don't quite meet expectations despite being good, and the stock falls to represent that. Furthermore, Games Workshop, I honestly don't know. I think they're going to do well, but I don't know if investors think the same. I imagine the share price is likely going to remain fairly constant. The three top topics of the week start with National Express, and they had announced that they are actually suspending their services on their entire network of coach services. They hope to resume these services by the start of March, and this is very similar to the actions they had taken in the first national lockdown at the start of 2020. Shares in NEX are up 8.64%. And this means that investors are likely more bullish on the outlook of this company, and that's likely because they've decided to cut costs and therefore have a plan going forward. Although it could mean we have a potential opportunity, earnings could be worse or better than expected, and therefore we could see an opportunity in their next earnings update. For the first time in 36 years, Greggs has announced that they will be making, or estimating, or expecting a £15 million loss. And they do not expect profits to return to pre-pandemic levels at the earliest until 2022. Naturally, Greggs had taken an alternative approach during the pandemic to make sure their business is as resilient as it could be given the situation. This has included a partnership with Just Eat, allowing them to do deliveries, but also another partnership with Iceland on their branded goods. Shares in GRG are actually up 4.72% for the week, which is interesting to me as it means investors are quite bullish. But Greggs is really hard hit as a business, and I'm not sure it's sustainable being at the levels of share prices currently at. This could mean there could be a pullback in the future, but then again, shares have rallied on these more negative results, so perhaps we're looking much further forward into the future where it might be 2023, at which Greggs are back at full operating standard. Lastly, we've seen another offer for a gaming company in the UK. Last year, we had the bidding war over William Hill Casino for around £3.7 billion, but this year, we have now seen an offer for a company called GVC Holdings. This is the parent company of Ladbrokes, which you'll likely now know. They had been offered £8.1 billion by MGM Resorts. Actually, my bad, they've changed their name to Entain PLC. What's up with all the companies lately just rebranding their names? Surely you're destroying brand recognition by changing it all the time. Obviously, with the Royal Bank of Scotland changing to NatWest Group, sure. But the likes of these big gambling companies, they have such obscure names like Flutter Entertainment and Entain. How are they going to be recognised? Sorry, this was a little bit of a rant on my behalf because it seems a bit weird that they're doing this. Maybe there's some rule against them calling themselves Ladbrokes, but at least then a lot more retail investors would know who they are without first diving into the company. Regardless, Entain plc had actually rejected this offer, and they had stated that it significantly undervalues the company and future prospects. And I'm inclined to agree, as the US are loosening their regulations on gambling, and therefore there is a lot of growth potential for these gaming stocks. A new feature I'm adding this week is the top movers in the FTSE 350, which is the top 350 companies on the London Stock Exchange by market capitalisation. This was actually a viewer suggestion, but please forgive me as I can't remember exactly who had said it, and that's because over the last few days I've had well over 200 comments, which is far more than I've ever had before, and it really takes a lot of time to put a dedicated response to each and every one of the comments, and so please forgive me as I have forgotten who had made the suggestion, but thank you regardless, as I think it will be a great addition to the series. Anyway, the top risers in the FTSE 350 were Energean with 22.88%, and this was due to acquiring Total's entire 50% stake in Block 2. I have no idea what that means, but hopefully some of you out there know. And there was also an analyst upgrade from 800 pence per share to 1075 pence per share, which is certainly likely a sentiment boost. Fair Expo had also gained 20.31% due to announcing a special dividend and that they had strong operational and financial performance in 2020. Petrofac increased by 20.06%, although I'm not entirely sure why, but I believe it's due to completing a promising project, but it is a sector that I don't understand and actively try to avoid, as I'm aware I don't have this understanding and therefore don't think there's much value in me learning about these stocks. The top fallers, however, were TUI Group, and they had fallen by 17.1%, and this is due to the capital raising from shareholders of £492 million. Aston Martin had dropped by 11.12%, and I'm not entirely sure why this has done this. It's likely just price volatility, although 4 weeks ago they had undergone a reverse stock split of 1-20. This is like a merger of the stocks and basically means that now the stock price is higher, although nothing fundamentally has changed. However, this isn't that great to see, as it could mean that the management are anticipating that shares are going to drop a lot further, and therefore they had bolstered up the share price inorganically. Lastly, Wizz Air had dropped by 6.84%, and this is likely due to the post-Brexit regulations, and they've now added share restrictions to UK shareholders. And also a truck had gotten wedged under one of their planes. And if you'd like a free share for signing up to Trading 212, please click the link in the description down below and deposit just £1. And when you use my link or promo code, you can get that free share. My personal top riser in the portfolio is one of my favourite stocks I hold. This stock is the Ashtead Group. This week they had returned 6.84%. And this is a stock that just keeps on giving, which is now going to prove a lot more difficult for me personally to find a position to average up on this investment. I'm not typically impacted by worrying about average share price, although I understand where they're coming from. My concern is that this stock has rallied a lot in the last year and it's nearly reached 50%. This could mean that we could be due a pullback, but at the same time we may not be due a pullback. Therefore, it's difficult to know when to buy this stock. And I'm not a fund manager, I've not got the capital available to wait 3 years for the perfect dip. Rather, I'm likely going to increase this position in the future, but it does mean that my average share price of £25.57 is likely going to be increased a lot, as current shares are trading around £36. I still hold 45 shares in this position and hopefully will buy some more in the future. My top faller in the portfolio wasn't actually a stock that had lost value, but rather had just literally gained the least in returns. Unsurprisingly, this stock is London Stock Exchange Group, and this is due to their definitive acquisition, which will hopefully be complete by the end of the month, and that's kept the share price quite stagnant. Furthermore, I had bought the highs of the week, which was around £93 on Monday, but this has actually got me thinking. I've been thinking about market capitalizations. I've been trying to research the historical market caps of companies in the FTSE 100, and I really wanted to know what the biggest company ever was in the FTSE 100. This is because the London Stock Exchange Group is a company worth £32 billion. This is a very large organisation, and I don't doubt that they could climb to the top ranks of the FTSE 100 and be one of the highest weighted, but I do doubt that they're unlikely to 10 times in the next 20 years. And this means the growth rate on the portfolio would likely be slower because this stock has less growth potential. And that's not due to faults of the business. I think a lot of their high growth stage is well far behind them. But they can't be blamed for this because this is just a natural business cycle. And I think this is due to an adaptation or constant changes to my investment strategy as I become more experienced, that I no longer value that 15% dividend growth each year as much, because I'm not drawing down on this income, and I think the growth potential in the meantime is a lot more important. Therefore, I'm weighing up the idea of closing this position, and it's very likely I will be doing this in the future. I just think it's very difficult for a company like the London Stock Exchange Group to go from £32 billion to £320 billion, and what I have noticed is that many fund managers already hold shares of this stock, like Keith Ashworth-Lord. I've made a video, he's like the UK's Warren Buffett, I'll put the card at the top right here, but he already holds around a 3% allocation to the LSE shares. And I think this is already a well-known share. Fund managers aren't just going to suddenly buy in and prop up share price. Acquisitions are there's still quite a high chance that this would happen, although with the Refinitiv deal they are now going to be a huge organisation, so maybe more unlikely. And I think whilst it's a quality share, I think the lower growth potential isn't worth it at my age. As I think a smaller cap company like that of a £1 billion, which is probably actually medium cap, not small cap, I think a company from that could go from £1 billion to £10 billion a lot easier than a company can go from £10 billion to £100 billion. Which brings me on to another stock I had bought this week. I had bought a share of Halma, and I love how they actively manage their portfolio of well synergized companies with high levels of specialization. I got that word wrong. And it's no surprise to see them valued at nearly £10 billion, although they are certainly, like Ashtead Group, which is around £16 billion, getting to the higher end of the spectrum in which I'd like to comfortably invest. I think my upper limit is going to be around £30 billion for a market capitalisation company, as I think they could carry on, double in value, get to around £60–70 billion, but at that point you're likely in the top 15 stocks in the FTSE 100, and growth is likely to slow down as there isn't much investing power in the UK compared to the likes of very frequent and dominating Robinhood investors in the US, which are the equivalent of retail investors. Therefore, whilst I'm confident in the outlook for Halma, I'm going to continue buying this stock. I think in the next 2 to 3 years, along with Ashtead Group, I should look at some alternatives and then slowly prepare for the situation where I'll ease out of these stocks and invest in smaller businesses with more growth potential for the future. At the moment, I'm eyeing up a few opportunities. I'm likely going to replace London Stock Exchange Group once the Refinitiv acquisition is done. Maybe I'll gain some shareholder value from it, maybe I won't. I'm likely going to buy into Team 17. I understand this business a lot more, and because I know of the Worms franchise and I've grown up around it, and they are of a much smaller valuation, I think there's a lot of growth potential to come with the business, even though they've had a fantastic run up so far this year. The likes of Halma and Ashtead Group, I'm likely going to go for smaller businesses, and I've seen a few small cap businesses around £300 million that are profitable, just as resilient as the businesses, but this could mean they have limited growth potential if they are growing at standard paces like Halma and Ashtead. I'd love to hear your opinions on what you think on my proposed changes to the investment strategy, and I still remain very bullish on all of these companies. I'm just trying to streamline my portfolio for the future. And I did say Halma is a stock that I would buy and hold for life, and I'd love to do that, but I think I could get better returns after a while in other stocks. This brings my total holding with Halma to 52 shares. The share tip of the week is a high-risk value stock listed in the main markets, not AIM. This is still under the London Stock Exchange, however. This stock is a higher risk because it's correlated to a very risky asset that hasn't been proved to be a store of value and is known as a cryptocurrency, more specifically Bitcoin. They've just become profitable, have a great balance sheet, and have had fantastic revenue growth in the last year. More recently, they've become dual listed in the US, and it's picked up a lot of attention, and therefore more money is going into into this, and currently they are very undervalued to where they could be compared to their competitors in the industry. This stock is called Argo Blockchain. If you're interested in my stock analysis, click the card at the top right of the video. I own shares of this stock in a Trading 212 portfolio, although something like 13 shares because Trading 212 doesn't know how to put orders through on their app. I'm likely going to buy an additional £800. I speak more on this in the stock analysis video, so if you're interested in that, click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a great evening. Even though this is up in the afternoon, that's really dumb on my behalf. You know what? Have a fantastic day.